Hi, this is Kim with AnnieMac Mortgage, and I'm here today to talk to you about why you don't need 20% down to buy a home. It seems like you've been trying for years to save enough money for a down payment for a home. You've cut corners, taken lunches to work, and yet home prices continue to rise, and your dream of owning a home seems out of reach. Guess what? Maybe you are closer to owning a home more than you think. Because for many loan options, you don't need 20% down to purchase a home. No matter how much you may have saved, there's probably a mortgage program that can help you right now to get into a home. Let's take a look at a few options out there. We'll begin with the FHA home loan. FHA loans allow for 3.5% down payment. FHA loans are insured by the Federal Housing Administration, FHA, and these loan programs are perfect for first-time home buyers. FHA loans require mortgage insurance premiums, or what is called MIP. Another great low down payment program is the Home Ready Mortgage. The Home Ready Mortgage requires a 3% down payment. It is a low down payment loan available through Fannie Mae. The Home Ready program allows for 3% down, grants access to below market mortgage rates, and offers discounted rates for private mortgage insurance. Home Ready also gives you the ability to use income from everyone who will be living in the home towards actual mortgage approval. This can include parents earning a pension or Social Security income, or roommates who want to go all in and buy a home together. Home Ready loan does have an income limit. However, there are many options and areas for you to use this loan. The next loan down payment is the conventional 3% down payment loan program, Conventional Home One. The Conventional Home One requires a down payment of 3%. You can make a down payment of more if you choose, but the minimum requirement is 3%. This program also allows a buyer's payment to be gifted by a third party, so you really don't even have to have your own money for your down payment. The only requirement is that the person who is gifting the money for the down payment is a blood relative, legal guardian, domestic partner, fiance, to be the buyer of the home. The property must be a one-unit primary residence, which can include a single-family home, a townhome, or a condo, with a loan amount up to $726,200. Another perk is that there are no geographic limitations on where you can purchase a home using the Home One. There are no income limits attached to this financing either. Another fantastic loan, a down payment program, is the VA home loan. The VA home loan is no down payment required. If you have served out your country, first, thank you for your service, and second, you have a great benefit with the VA home loan. They may not have told you a lot about the VA home loan in boot camp, but it is a pretty cool benefit that you should definitely consider. VA home loans are available to active duty members of the U.S. military, honorably discharged service members, and many surviving spouses. VA home loans are among some of the best low and no down payment mortgage programs available today because they require no down payment whatsoever and never require the buyer to make mortgage insurance payments. The VA home loan can be used for most any type of home, including single family, condo, and multi-unit. VA loans, like FHA, are assumable by future VA home buyers. Now let's look at another great no money down option, and that is the USDA loan. USDA loan is also no down payment required. The USDA loan is guaranteed by the U.S. Department of Agriculture and allows for 100% financing. USDA loans often are thought of rural loans, but they are also available in non-rural areas, including within many U.S. suburbs. One of the biggest benefits of the USDA loan is that its mortgage rates are often the lowest of all the low and no down payment options. The mortgage insurance premiums are also pretty low. In order to qualify for a USDA loan, the income of a home buyer's household may not exceed the local median by more than 15%. Next, let's look at conventional mortgage options with private mortgage insurance. Conventional loans with PMI. I know you've heard of it. If you are looking to get into a house with less than 20% down, a conventional home loan will have private mortgage insurance. Private mortgage insurance, or PMI, is a type of mortgage insurance that protects your lender if you stop making your payments on your loan. PMI only applies to conventional loans, but other loans programs like FHA requires mortgage insurance too, although mortgage insurance on FHA loans operate differently than PMI. How much money you put down plays a role in PMI, what your credit is. A small down payment means a bigger risk for the lender, so your PMI may cost more. The type of loan you get, like a fixed rate mortgage or adjustable rate mortgage, will also affect how much your PMI will cost as well as your credit score. One of the biggest advantages of PMI is that you may be able to get rid of PMI at some point in the future. This means after what you owe on your mortgage is below 80% of the value of your home, you can write to your lender and ask them to remove your PMI. If you qualify, it would mean that your monthly payment would decrease. PMI gives you the option to get into the home with less than 20% down, which can help you realize the dream of homeownership. Finally, let's look at what's called a piggyback mortgage. Piggyback mortgage is 10% down payment. The piggyback mortgage is not really a mortgage at all. In fact, it's really two separate mortgages. It's called a piggyback mortgage because one mortgage is piggybacked on top of another in order to borrow 90% of your home purchase's price. The loan is also sometimes called an 80-10-10 mortgage. The piggyback mortgage allows the buyer to put 10% down for the down payment. This loan allows you to avoid having mortgage insurance. Instead of one mortgage, you'll have two. The first mortgage is typically a conventional loan and is approved at 80% loan to value of the home's purchase price. The second mortgage is typically a home equity line of credit that is 10% loan to value. Piggyback mortgages are often used by home buyers who plan to pay down or reduce their balance on their second mortgage within the first 24 months of home ownership. Whichever loan program works for you, it's important to remember that you have options. You may not need to wait for 20% down, and you may not need to wait to get into your dream home. Thanks for watching. This is Kim Gasca with AnnieMac Mortgage. You can connect with me or Kim Gasca team at the information listed below. Have a great day.